now have next up our final panel discussion of the afternoon. We'll switch out the water real quick up on stage, and I'll announce who is going to be joining us for this one. Over the past few sessions, we've talked a lot about Europe's, I would say, internal dynamics, about markets, regulation, access to capital. But none of that happens in a vacuum, and the global power balance is, of course, that's also been an issue of discussion today, shifting economically, politically, and also technologically. So our final panel today will zoom out a bit on all of this and explore exactly that, the geopolitical shifts and Europe's place between the United States on one side and Asia on the other side. So it's a global VC perspective. So please now welcome our panelists for this one. It's going to be Xiaomin Mou, who's Regional Head of VC for Turkey, CEE, and Central Asia at the International Finance Corporation. Roland Hinterkörner, Managing Partner at Alpstein Capital Management. We have with us Roman Scharf and Jonathan Crook, the Deputy Head Venture Capital Unit at the Office for Investment of the United Kingdom's government. And our panel will be moderated by Nina Wöss, who's Managing Partner at Fund F by Female Founders. Please welcome them all with a round of applause, and the stage is set for you.
Amazing. So thanks for staying with us. I'm very happy to be here with four very accomplished and also different individuals, both in their background, but also regional exposure. And that's what we will discuss in the next 45 minutes roughly. And in order to also enable you to get to know my panelists a little bit better, I would actually like to start off with a brief round where all of you give us insights in how specifically the geopolitical developments across the continents, also having this question between Europe, Asia and the US, how has this influenced your day-to-day work? And I would say, let's start with Xiaomin next to me, and then let's go through the panel, and then we can take it from there.
I would say that, thank you so much, Nina, and thank you, everyone. I would say that because IFC is an emerging market investor, we don't invest typically in the US. As a venture investor, we used to be very active in China, but we pulled out in 2018 as China graduated. So I think the geopolitical shifts that's happening has affected us a little bit less. Mm-hmm. But what we are seeing is that our capital, I think all of the issues that we're going to talk about does impact the emerging markets as well. And I think we have a very strong focus on Central Eastern Europe as a result.
Lovely. Thank you so much. Roland?
Well, I think geopolitically, obviously, we are in different times, and we've heard it in many panels before. Maybe I want to briefly touch on one aspect, which is government debt, which is obviously spiraling into the stratosphere everywhere, and particularly the US. Obviously there's a big debate about what we do about interest rates and how is this going to go forward in terms of sustainability. I would think there's two schools of thought, really. One is that people are saying, well, we'll have resurgent inflation again, and interest rates will have to go up to battle that. The other school of thought is obviously the MAGA school of thought, where basically the MAGA troops are saying we can manage this. We have tariff policies in place, or not in place, but in the making, and they're obviously pushing for interest rate cuts. So they're doing the simple calculation of tariffs of 10 to 15% will get the US Treasury something like 300 billion a year, and a sizable interest rate cut will cut interest rates by whatever, 100 to 200 billion, which they say is already a third of the budget and the budget deficit, and that will mean that interest rates will come down by themselves because there is solidity in state finances. We'll have to see about that, but I think this is equally important to see pan out, as is obviously the geopolitical landscape.
Over to you, Roman. How are you looking at the landscape nowadays?
Well, my perspective is strictly from a venture capital point of view. I've moved to the US in 2005 when there was no US activity, venture capital activity, apart from here and there. We were actually the first Sequoia capital investment in Europe in 2005. It was a novelty back in the day, and we had to move our headquarters to the US because there was no concept of maintaining relationships with portfolio companies outside really 30 minutes driving distance from Palo Alto. And then I returned from the US in 2015 into an environment where there was already a lot of European seed funds, angel investors. Germany and the UK already had some bigger funds in place. And America was more and more active. Not as much as I would have hoped. So I spoke with some of the VCs, what's holding them back, and they were complaining about Europe being so heterogeneous and not a clear heat map where to go, different languages. But they already did appreciate the fact that in Europe you get more shares for your money lasts longer, and you can attract really strong talent, which in Silicon Valley is very hard because 5 companies skim away all the great available talent, and for normal startups it's almost impossible to hire engineers. And now it's another 10 years later, 8 years of which I have run my own venture fund. We have done more than 20 investments, and most of them are together with US VCs. And so when I look at this 2005, 2015, 2025, I see that no matter what the political direction was, no matter what the macroeconomic situation was, venture capital was going to the next level continuously, and that's what I expect for the next 10 years as well.
Okay, a few strong statements that I will get back to in the course of the conversation. But first, Jonathan, how has your daily business been affected?
I think in the past 18 months there's been a profound recognition that the world is increasingly competitive. And by that I mean both in technology, and it's been spoken about today how I think a term used by a previous panel member was 6 months now is what was achieved in 2 years previously in terms of the speed of technology development. But increasingly there's an understanding that in the competitive world there's a need to collaborate both in capital but in intellectual property and bringing mutual strengths to bear for the collaborative benefit.
So basically picking that up actually right away and starting with you. So how are these changes reflected in current strategies that governments have and that fund of funds are using also to deploy their capital in Europe? Also looking at the rise of certain technologies, focusing on certain technologies. What have you witnessed there in also how you are approaching it from the UK?
Well, I think actually just to dwell on some of the previous panels we heard, indeed the first one this morning about the proposition of the government of Austria becoming more involved from a fund of funds perspective. So across the developed world, we very much see that as the UK government, and indeed in the United Kingdom, the British Business Bank will be substantially increasing the amount of capital it has for the next financial year. And we probably contribute as a fund of fund about 30% of the market. Now, what's really fascinating is we pick apart in the developed world and we look at fund-to-fund activities from the public sector, how much, very frequently, it's driven by an explicit national strategy, particularly in places like Asia, whether it's Japan, Korea, or Taiwan, where there's a very clear statement of which technologies and why, over what time frame there's a desire to develop. And then, of course, there's a recognition within the market of which are the most appropriate venture capital funds to receive capital.
So do you see any changes imminent also in European strategies as well? Because what I've witnessed as a fund manager myself, it does most of those fund of funds have quite broad mandates. So they're basically investing in generalists, maybe some in climate, some in health. But is this already too fragmented in terms of like focus on certain technologies from your day-to-day point of view?
That's a very good question. So we certainly in the UK are seeing a lot more interest from family offices and very specific subsectors reflected by a desire to find GPs with quite in-depth knowledge and experience. Even if they're just a first-time manager, that's fine, but it's a case of how much do they know and how much experience do they have in that sector. Then on the, obviously, pension funds I think are going to be absolutely fundamental across Europe, how we are able to do things at scale. And another factor, which again, I think has really resonated through all the panels today, is speed. And the ability to move at speed, both from the perspective of the deployment of capital and the achievement of technology. And again, that links into some of the operational processes of individual VC firms.
That makes a lot of sense. I mean, talking about speed, that brings me to US VCs, that brings me to you, Roman. As you're basically collaborating with mostly the big brand name US VCs that we all know and also admire to some extent, what do you see in their perception of Europe? What kind of targets are they looking at? Why do they keep investing in Europe? And actually, do they, if some of them actually closed down their offices again that they all opened up in the hype cycle?
I think they're picking the raisins. So they have choice because they're really good and strong founders would always choose Sequoia over a random German or UK fund. And it's still true. It's the brand, the platform. And having been a portfolio company in Sequoia, I know what I'm talking about. I mean, the amount of support they gave us in the first 12, 18 months, it was spectacular. Different partners, not just one, made calls, supported us in different meetings, helped with strategy, and that is a concept that European VCs are now also starting to adopt, this hands-on mentality. For America, I think they have found some ways to handle the time difference and the travel burden because there's really good companies here. Do I think they should do more? I'm split between thinking, yes, they should do more, but I'm also thinking Europe should do more. We should not leave them the best deals without a good fight. And this is especially true in the later stages. So I started a Series A fund in 2018 because there was not many Series A funds. Now I'm thinking, well, what about Series B and Series C? Because there's almost no competition to the big US brand names, and we need to fix this. We should not kind of create an environment where we leave all the deals for the American VCs. It's good that they do them. It's good that they're present. I love to have US VCs on the cap table of my portfolio companies because most of them, more than 80% of them, are selling software in the US. And with a US VC, that's a doable exercise. I would say without a US VC on the cap table, conquering the US market is a mission impossible. And that's really good. But Europe needs to be stronger. We need to play better cards. Some people are calling for a European EU Inc. We need a legal entity that serves our needs so that we do not have to encourage our own portfolio companies to become Delaware companies. It's paradox, but we do encourage our portfolio companies to set up in Delaware for the future. We need. I think one of the most prominent players in our industry said we need a European stock market. It was not the German politician who came up with this first. There was people from inside the funding world who came up with this idea, because there's no IPOs in Europe. So whatever strong European tech company you have, they will either get sold, and then 8 out of 10 exits are to US buyers, or they go public, and then 10 out of 10 IPOs are US IPOs. So instead of asking, what do we do to attract the Americans more and get them into more deals, I think we should ask, how can we do the best deals ourselves?
Yeah, very much agree. I mean, the good thing is that at an event like this, there are a lot of policymakers in the room, and there is a lot of great ideas actually already also on the table. EU Inc. has been mentioned already. Before we dive into that, as you have also been nodding quite a bit, Xiaomin, over to you, as you're also working specifically, also said, with CEE, which is still considered as a more underdeveloped market than, for instance, Germany, UK, France, and the likes. So what flows of capital are you witnessing there? As from the perspective of an Austrian, there is still basically starting off at pre-seed seed to actually bring the companies to Series A and beyond, as has been mentioned now. How does it look like for you when you're actively investing there? And where do those fund managers raise their money?
I think that's a really great question. I think there are quite a few layers there. So I'll just take it from, first of all, when we look at CE fund managers, I think over time, so our key markets are Turkey, Bulgaria, Romania, and the like. And so over time, they started raising money, a small pocket, perhaps 30, 40 million euros, and then typically, I think all of these fund managers are raising about 80 to 100 now for their subsequent fund. And they're all coming up around the same time. And they're still raising from typically the same type of LP. So in this region, DFIs are dominant, like the EIFs, and thank goodness for them, right? IFC typically comes in the second or the third fund. We typically want to see a track record. Because we're a global investor, we have to compare all of these funds to our other funds. So in Latin America, in India, and some funds that we did in China before 2018. So I think the competition's a bit stiff. And if you look at CE, it is still very much still growing, but we've seen the CE funds invest in quite a number of really strong companies, right? So if you look at their portfolio, the Bulgarian company Payhawk, UiPath was invested by Early Bird Digital East, which we invested. It was the most successful VC fund, I think, in its vintage year in the history. But I think the interesting is that we've talked about the geopolitical shifts, and I think there is a decoupling of U.S. and China that is very obviously happening. And I think on the capital flow side, on the one hand, in February 2025, the U.S. basically, the government mandated that the U.S. VCs pull out of China, and so Sequoia had to divest its investments in investments like AI and semiconductor in China, and then the Chinese Sequoia basically had to rebrand back to Hongshan, right? So there's this decoupling, and then in later this year, China then, basically it's the sovereign wealth fund, China Investment Corporation, is barred from investing in private equity in the U.S. That means, and they have, this is like a $1.5 trillion fund that typically invested in the Carlyles and the BlackRocks, and so now they're sitting on a pool of funding they can't really deploy to the U.S. anymore. And so they've been doing their due diligence in the last year and two. They've been looking at Southeast Asia, Latin America, but in general, they're coming to the conclusion that these markets are quite volatile, right, compared to the European market. And we're seeing, and I'm not based in China anymore. I was based there until 2018 for 10 years, but I have a lot of colleagues and friends that are still in the business. And anecdotally, they're seeing, for example, European fund managers going to China. They used to go once a year. Now these fund managers are going 4 times a year. And they see an opportunity to fundraise from a different a source that they haven't really considered. So I think the flow of funding is opening up opportunities for the European funds. And I think it's a great timing because I said these funds are going from 40 million to now about 80 to 100. Their next fund is going to be large, presumably larger, and they're going to need more LPs than the existing base here.
I would say that's actually very good news for all the fund managers in the room, especially for those raising bigger amounts of capital, as these are substantial sums that are about to be deployed or potentially deployed. I mean, also, yeah, I wanted to jump to you, Roland, there. So how are you looking at that from a...
echo that? I mean, the fact that there's decoupling, the fact that there's IPOs in the US, doesn't mean it's not happening in China. It's just a blockbuster year this year. And for people who don't know, it's the #1 IPO market in the world at the moment, right? We have 80 IPOs so far this year, and big ones are only coming with Pony AI and WeRide, very prominent autonomous driving plays. And I think the total IPO volume has been in excess of 26 billion. So I think we have a good chance to close the year close to $30 billion, which is massive, right? So that may be the case that money cannot be invested in the US anymore, but there's no shortage of investment opportunities in China, and they're mostly tech companies. I think the most prominent example is CATL, the contemporary Amperex technology, which is the largest battery maker in the world. They alone, I think, issued something like 5.3 billion in new money. So it's gangbusters. It's crazy what's going on there. And that is why all of a sudden Europe's interest has been awakening again. Because I remember I've been going to Europe to raise funds for all kinds of asset classes up to 2018. And everybody was like, give me a piece of China, I want China, I want China. And then all of a sudden it fell off a cliff for well, COVID reasons, propaganda reasons as well. And all of a sudden you saw these ETFs and funds spring up that invested in Asia ex China. I mean, how ludicrous is that, right? But it was obviously a trend, the zeitgeist, and it excluded China. These days, with the activity that we're seeing, everybody is asking me about China. How do I get in? Have I missed the boat? What is the best asset class? So that's something that has come back with a vengeance, and it's despite these decoupling efforts and so on.
I mean, speaking about the FOMO that is now kicking in, so what has Europe missed in the past? So what were the misconceptions that maybe also prevented relevant players from, looking for deeper relationships there, looking for investment opportunities in both directions?
I guess the question is really, what are they missing at the moment, right? Because my observation is that politically, they're really missing the boat. And that is by Europe basically not changing its behavior vis-a-vis China. If you look at one example like Germany, the conduct in their China policy is basically not different from the previous government, right? So Annalena Baerbock was talking about the value system of Europe that needs to be imposed on China. Now politicians are talking about the interest of Germany that need to be represented in this systemic rivalry of sorts, right? For the Chinese, I don't know whether you agree, it's one and the same, right? They don't care, right? What has really changed is the conduct of the Chinese. They basically have become a self-confident bunch that will not take no for an answer, and they've learned how to put the foot down. Maybe speaking in the words of Donald Trump, they have cards and they're willing to play them, right? We hear these headlines all of a sudden after the APEC summit that the tariff levels are back to 47%. Nothing could be further from the truth. If you look at the blended tariff levels on China, they are in the low to mid-20s, which is exactly where we started out before Liberation Day, right? And then obviously we had the exposure on trade, which has been reduced dramatically, whether friendshoring or onshoring or nearshoring is happening. I think the the Chinese exports of total into the US has gone from the heydays of, I think in 11 or 12, from low to mid-20s to 13%. And maybe by the end of the year, we're at 12%. So there's no more material exposure anymore. ASEAN region is the predominant trade partner now, with 17% roughly of the total. There is Europe with 15%, but even here, China is not as desperate anymore, like in the first Trump administration, to compensate the reduction of US trade with European trade. That's over, right? Obviously we've had the rare earth metal debate, and there China has obviously been has made concessions on that, but let's face it, those are not agreements, they're framework agreements, which means they're just a truce and they're going to be renegotiated in a year's time. And China has the monopoly on these ones, and nothing in the world will move without them, right? So I think that should reflect on China's position these days in the geopolitical world is much stronger, and China cannot be messed with anymore.
So what does this mean for us as a continent? If we want to stay at the table playing cards to keep that image, also for the bigger picture, what's going to be the driver? What's going to be the choker that we want to show? Is it something like EU Inc., basically uniting us, opening up certain levels on the whole topics of rules and regulations? Is it focusing on certain key technologies that will save us from certain dependencies or change how dependencies are working nowadays? Is it more capital? Is it the belief in Europe? How does each of you contribute to Europe actually staying relevant and to make sure that also future generations are enjoying our continent and are enjoying a prosperous continent? So maybe starting. Yeah. Okay, Roland wants to start.
Let's look at the investment flow from Europe to China. I mean, it is, and I don't want to beat the Germans up here, but it is very difficult for a German entrepreneur, industrialist, to actually go to China and do business. I mean, what do you do if you have the foreign minister running around India and Japan and basically scolding China from there on Taiwan and human rights? I mean, what is an entrepreneur to do if you want to be part of the biggest market in the world, and then your politicians are basically not exactly conducive to your objectives, and your chancellor Merz is basically telling you, don't invest in China, because if anything were to happen, you're going to be on your own, right? I mean, that's obviously something that is not very helpful. When it comes to the other flow from Asia to Europe, I mean, Nexperia obviously has put a dent into it, but there is an established investor base in Europe, there's no doubt. I mean, let's face it, Mercedes-Benz has a 20% shareholder, two 10% shareholders that are Chinese, right? There is obviously countries in Europe that are much more welcoming to FDI out of China. That is Spain, for instance. Contemporary Amperex is about to build a massive battery factory there. Or Hungary with BYD, and again, Contemporary. So that is working. The question is, what are the policymakers going to do next after Nexperia? And that was a shot in the knee anyway. What are they going to do next in order to prevent the Chinese from actually saying, look, we don't want to go there, and we're not really keen on this anymore. So it's a double-edged sword, and it needs to be maneuvered very carefully within that geopolitical context.
Mm-hmm. Okay, that was a lot of information. I see the other panelists thinking. Maybe moving over to the policy side again, and handing to you, Jonathan, like as an outlook of obviously UK not being part of the European Union, but luckily the UK being part of a wonderful continent. So how much unity do we need, and is it actually likely that we achieve this unity, or are we waiting for something that maybe will never come, and each state has to make decisions on their own? Can this be successful?
Well, first, from the UK perspective, a really significant point is the publication and indeed a very significant pursuit of the industrial strategy, which sets out very clearly objectives for the UK's economic growth and achievement of national resilience for the next 10 years. And what's interesting within that is that there's very much a clear articulation of the need to collaborate with, yes, we are part of Europe, of course, in terms of the geography. And it's that mutual recognition of bringing strengths to bear. Because yes, we are the third largest venture market in the entire world. Yes, we've got some amazing companies which are coming more and more from spin-outs from universities. And what's fascinating to see is the founders are increasingly foreign, because despite the consequences of Brexit, we still have very, very driven individuals who come to the United Kingdom for the highest education possible and then see the opportunities of starting a business and growing the business in the UK. And then there's more, I would suggest, a political understanding of our immediate market opportunities in Europe, but also that wider, we're all in this together. We've all got similar problems, whether it's interest rate on debt, whether it's demographics, whether it's the state and nature of our infrastructure, and we all need to come together from policy to capital to IP.
Strong statement, I like it. Roman, do you think the US will still continue to consider like picking the raisins with European founders and the perceived great founders always moving to Silicon Valley because it's just such a strong magnet? Or is there any chance in also like keeping people like that here in times of like racism changes to actually build these strongholds in Europe as well?
I'm sure Americans will try to pick the raisins because they're sitting at the table playing card to win. And we could hear statements that emphasize that China is also sitting at a table to win. Europe is sitting at a table to sit at a table. And that is a fundamental problem. Yeah. I cannot change that. I spend my time investing in strong founders who make a difference from starting to employ 20 people, 50 people, 500 people, 5,000 people, and contribute to technological, progression and oftentimes to making society or the world better in one or the other way. But I wish we would have someone who sits at a table to win, because we have still, a very big market. We have very strong talent. Europe as a continent has extremely strong education, and we just need to decide that we are one group and not 27 plus one. And I don't know when it will happen. It will happen in my lifetime or not. I hope it will happen soon, because these other two parties, they are killing it.
So I did want to just interject very quickly, and we might find this amusing as a cultural point, trying to meet a leading US VC in San Francisco in January. I got a simple reply of a meme of one of the Musk's rockets being caught by the chopsticks at the same time, next to a video of a bottle cap being taken off but not coming off, and saying US, Europe. And that point, are you just sitting at the table or are you going to compete? This is the wake up.
And I'm just going to echo, Roman is investing in US startups or European companies that go to the US right away. We, because we're a development institution, finance institution, we try to invest in companies and keep them where they are, right? So we do get involved in if we were to come in direct investment, we would come in Series B. By then, these companies that are still raising Series B in Central Eastern Europe, they find it really tough, right? There's not a lot of growth capital in Europe, and most of them are coming from Germany and France, and it's a conundrum. If they don't show traction in the US, no US investor is going to come in. But so then they get some of these European investors to come in. I think the scrutiny it's really hard for these CEE companies, right? And imagine if you have to start splitting your life and go to the US, and this is really difficult. When I was in China 10 years, you've never seen a founder having to move to the US. They might have a Delaware co, they have a wholly foreign-owned entity in China. They will operate that way, fully intact, everybody in China, until IPO. They only go to the US to access US money if they decide the Hong Kong Stock Exchange is not, they don't understand their business model as well as the US market would. And so I think that's really tough for the European companies that we're seeing. And we're seeing the VC funds that I spoke of, the ones that are 30, 40 million, they're already asking LPs to extend their the timeline, right? Because they just can't exit, right? The exits are far in between, and if the exits come at all, the M&As, often they're at a depressed valuation. So I think the CE companies are getting a really harsh, end of the stick, and it's tough without a big European market. It's just impossible.
Let me just add, we encourage all our companies to keep R&D engineering in Europe.
Of course.
They only go to market in the US because in software it's the biggest market.
Yeah, of course.
But it would be silly to encourage founders to hire engineers in America because we get better people for less money, specifically in the CE region. And I think that's also some sort of blueprint for success. UiPath is a lighthouse company, but we have others that are following in their footsteps, and we would love to have more Series B and Series C funds in Europe, but they don't exist.
So just a point on market. We've spoken a lot about the need for scale-up capital, but one thing I think is really fundamentally important is how do the fantastic tech companies achieve revenue? Where do they get the customers? And I think it's incumbent on a number of established corporations to really harness innovation and to work with some of these scale-ups. And it's a cultural issue. It's rather concerning. I mean, if we also look at then the incidence of corporate venture capital amongst some of the leading companies within the stock exchanges in Europe, then again that resonates, because I think to a degree now defending themselves against the inevitable. But again, it's a cultural thing of speed, desire, innovation, which Europe now need to harness because it is incredibly competitive, as we have realized over the past 18 months.
So also looking at the fact that unfortunately our conversation will end soon, I will try to also summarize some of the points. So I see one advantage that we have touched in this very, I would say, tough conversation. That's the fact that GPs, European GPs, can now diversify their LP base and should actually really actively consider addressing LPs that they haven't addressed before, and that's a trend that you are already seeing on a daily basis, something that I've also heard. So not only going to the US or Dubai, but really also going to Tokyo, Hong Kong, and the likes. But then also, and I'm glad to also be with panelists that are just also not afraid to also tackle the tough points, to basically, realize that we are still waiting for a wake-up call, which is always quite of a surprise to me, being European, because I think the wake-up call has happened, latest 2022, as also we heard in the previous panel. But it seems like many, especially of the policymakers, because many of those things are actually connected to policies. I mean, let's be honest, that's not something that a private fund can change on their own. That's also not something that one European country can change on its own. We are far too small in that. So that's basically also a call to action then to organizations like Invest Austria to keep lobbying on a pan-European level to actually set moves in the right direction. I would be very, very sad to be at this panel again 5 years from now, 10 years from now with a similar outcome, because this would mean that it further deteriorates, and we definitely would not want to see that as investors that are actually forward-looking and looking for like the best-in-class investments. So I would say that's a clear call to action to everyone who can actually make a difference, and to basically work on that together. Thank you, everyone.